happy.
It's a beautiful morning, but not so beautiful for the market, Sonia.
Yeah.
And as you said, I think the FI outflows are a little bit worrying, and I think we'll discuss that in more detail.
Absolutely. Yesterday was a bit of a surprise, right? I mean, the way the market sold off, it made a higher high and then it just completely collapsed. So let's just quickly tell you what you need to know as we begin another trading session. I'll start with where we left off, which is basically a 300-point fall, a nifty fall that we had yesterday. And it was, of course, a mix of factors. It's never one thing. It's a mix always. And it was certainly so yesterday as well. I'll come to this, but I mean, look at that, 1.5%. At one point, it looked like the Nifty would be down 0.5%, 0.75%. But in the last hour, I mean, it fell more. And finally, it was a 1.5% cut. Now, overnight, markets are just okay. I mean, they basically made a slightly higher high. S&P 500, a quarter. NASDAQ about 0.4%. The Dow also. By the way, all these indices are holding on to new all-time highs. The Russell 2000, of course, the big underperformer, that was down slightly, but nothing very, very large. The 10-year is holding above the 4-year. The 10-year yield, that is in the US, again, I mean, 3 basis points up, 3 basis points lower, but largely unchanged, 4.14. And the dollar index has moved up a tad bit. It's at about 103.5. So those are indicators which we track every day. I mean, oil, not very much has moved. It's at about $79 a barrel. The first batch of US big tech earnings came through. Netflix reported numbers, and numbers look optimistic, which is actually, pretty good news. There's also news which we mentioned yesterday morning. Of course, the US presidential race, which is going to happen. The elections are happening later this year. And in all likelihood, it's going to be Trump versus Biden. Trump, of course, won the Iowa caucus. That's last week. And it looks like he's basically he's got the nomination in New Hampshire as well, which is one of the first states to go for primary polling. Now, this is something which will sort of, dominate a fair bit of, slowly but surely, I think markets will start to fixate on this once again. What if, and by the way, given the fact that the current sitting president, US Biden's ratings, etc., are on the lower side, relatively speaking, I mean, what are the chances of Trump? And I mean, that kind of line of thinking will come into focus over the next couple of months as well. Now, let's just come to the market here. Now, the Nifty yesterday sold off. It basically sold off and broke the recent low, which was 21,285. We left off about 40 points under it. 21,240 odd was the close yesterday. The Nifty Bank low, similar low, was 45,430, and we broke that as well. We left off at 45,015. The Nifty Bank, of course, has been much weaker, much more weaker as compared to the Nifty. It's a mix of factors, as I said. What are the factors? It's a sharp run-up that we've seen. Profit-taking naturally comes in. And I would say it's a good thing, especially what we saw yesterday. Public sector companies, especially these railway stocks, right? 6 or 7 of these railway-related stocks, all PSUs which had run up in one straight line without a break. I mean, letting off some steam once in a while, I think, is absolutely required. And that is what we saw yesterday. But it was bigger than that yesterday. HDFC Bank, for the last many days since results came out, has been hurting. That's a large heavyweight. Yesterday also, if you had to assign blame, HDFC Bank index points was the largest culprit. Zee setback, I mean, it's a large big $10 billion merger, which is not going to happen. I mean, sentiment-wise, it's not just about how much weight Zee has, but it's just a sentiment setback. Of course, earnings which have been coming through at the margin, they've been a bit subpar as well. There's just one more thing I'd like to touch upon, which is, and this was talked about quite a bit in the last 1.5 odd hours or so, which is that the deadline for disclosure of FPI ownership rules, these are SEBI's rules, and the deadline is the 1st of February this year. It was cited as one of the reasons for the sell-off, that FPIs and FIs are going to sell over the next many months. There was a report in one of the newspapers which put the number in terms of potential sales, which could be to the tune of 1.5 lakh to 2 lakh crores over the next 6 months. I think that's just, a bit of an exaggeration. If you look at yesterday's figure, FII sold about 3,100 crores or so worth of stocks. It's a large number, but it's not unusual. We've seen, on bad days, because the base has become so large, 6,000, 8,000 billion dollars of sales. So, the number standalone is meaningful, but it's not very, very large in that sense. And the feedback, I managed to have a word with a couple of people, and the feedback is that, well, the issue is real, and FPIs will need to find a way around it, but because they have 6 months from the 1st of February to sort this out, a way out will be found. and it's unlikely to be as disruptive as some of these reports, etc., were making it out to be. But it's a live issue, and we'll get you more on this one as we go along. Just I want to wrap this up with two levels on the Nifty, and this is a level we put out for the last many days. Support comes in at the 38% retracement of the big rally which we saw from the lows of October 23 to January 16, 2024. That was the high that we made, and that number is just under 21,900. I mean, just take 21,900 as that support, and that's the big one. Similar retracement, the high in the Nifty Bank was not made in Jan, but in December last year, and the retracement of that October to December rally is 44,600, and that's a support which is about, what, 1.5% away from where we left off on the Nifty Bank as well. Closer there, I think, it makes sense perhaps to go in and, buy. But give it time. The market is digesting a fair bit of stuff. The GIFT Nifty is indicating about a 70-odd point higher start this morning. Sonia.
Oh, absolutely. And, yesterday, the big takeaway was the capitulation, first signs of capitulation in the broader markets. And we had spoken about this on Editors Roundtable as well last week, as to how the mid-cap index is starting to get a bit cautious now, and valuations are very, very stretched. I think that's the theme for today as well, and over the next few days, just be a bit cautious in the mid-cap end of trade. There was also large selling by foreign investors yesterday, so FI sold about 3,100 crores in the cash markets, and as I said, a large chunk of this is coming in the mid-cap space, so keep an eye out on that. The valuations in the mid-cap end of trade are stretched compared to the large caps and compared to the overall Nifty. Also watch for the PSU index. The index itself was down 4.5% yesterday. And first signs of selling is what we saw in the PSU Bank index yesterday. It was down about 250 odd points. Looking at some numbers, now Axis Bank's numbers are a bit mixed. The operating profit growth was weaker than peers. So in that sense, there was a bit of disappointment. But the loan book has grown 22% overall, with a big chunk of the loan book coming in from the SME loans. It's a mixed picture, but largely you'd have to say there are some disappointments. So maybe the stock could be under a bit of pressure. But a lot of other stocks in focus. Pidilite reported a very good set of numbers, volume growth of 10% plus. It was a steady quarter from Tata Elxsi, strong earnings from Sona Comstar, from KEA Industries. And in results today, you have a long list. There's Tata Steel, Tech Mahindra, Bajaj Auto, TVS Motor, so lots from the two-wheeler space as well. It'll be a very good quarter for the two-wheeler sector, but a lot of that perhaps is in the price. But just watch out for global markets too. The Nasdaq futures have actually gained a bit after Netflix posted a jump in subscribers. So that was the big takeaway from the global markets. And the GIFT Nifty implied opening is suggesting about a 60-point up move. But I think, now you'll start to sort of separate the men from the boys, especially in the mid-cap end of trade where things are looking a bit cautious.
Well, that's right. Sonan, yesterday the end to trade actually was particularly worrying. Yeah. And this FI selling is worrying me. I made this point even on closing bell, that there could be a technical factor at play with regard to the disclosure of the FIs. And that could be one of the reasons why we could see a big sell number. Because just take a look at what's happened in the last few days. The last 4 sessions, you're either seeing $500 million of selling, close to around or to more than $1 billion of selling. And that's getting a little bit worrying. As we had mentioned yesterday as well, there's a technical reason at play. SEBI has tightened the ultimate beneficial ownership norms. That's starting on 1st of February. So that could continue for the next few sessions as per the feedback that I got. And yes, you just pull up the Nifty and you pull up the Nifty Bank. The way the Nifty Bank fell off, that indicated that there could be massive FII selling. And the gross volumes were extremely massive. Yes, the net number was close to 3,500 crores, but the gross volume was very, very high. Why is that? Because the FIIs have highest exposure to the Nifty Bank. Also, I look at the delivery on the Nifty stocks. On an average, for the last 20 days, the average delivery on Nifty stocks is around $1.8 billion. Yesterday, that number was $3.5 billion. So the delivery-based action yesterday was double of what we saw on an average on the Nifty stocks, telling you that some of these stocks that have high FI ownership, there was massive selling, and that was indicated as well towards the end of trade because big volumes out there. How are the FIs positioned in the FNO market? They're net short, close to 19,000 contracts on the short side, and they're net short with close to 53% of their positions on the short side. The PCR, it's coming down to the lower end of the range. Not to say that it can't go down to around 0.65 odd, but now it's at the lower end. Normally at around 0.65, you see some bit of a bounce. That's because yesterday you saw aggressive call writing, 21,200, 21,300, 21,400 call. Between them, they added more than 1 crore shares. And we are in expiry week as well, so the bears feel they're in control. And that's why we saw very, very aggressive call writing in trade yesterday, which brings us to the levels. On the downside, the 50 DMA, 20,900. That becomes a crucial level that you're looking at. Support is in this vicinity of 20,800, 21,000. You don't want to look at a level below that. Otherwise, you could see a very, very sharp correction. So most market experts are looking at the 20,800, 21,000. While on the upside, till we get past the 21,700, because we visited them so often, and then in fact, we couldn't conquer that. So that becomes a resistance zone on the upside. The Nifty Bank, two levels I'm looking at out there. The 100 DMA, that's important, and the 200 DMA as well is the one that I'm looking at on the downside. My advice would be, don't deploy on your money on the long side if you want to go long. There is likely to be some selling, and this gap up may not sustain. That's the gut that I have going by the FI selling. But individual stocks will provide great entry opportunities, the high quality names, particularly that have high FI ownership. Also watch out for any kind, there is some hope that maybe there'll be some kind of amendment to this circular that came out. We'll wait by for that. But for the time being, this FI selling is worrying me.
Oh, absolutely. And especially in the broader markets. So we have lots lined up in the next 2.5 hours. Without wasting any time, let's kickstart the show. In the first half hour of the show, here's what you'll get to see. We'll get you updates from the market across the globe. Cameron Brand of EPFR Global will join in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day.
Okay, well, let's get you some money market views as well. On the rupee, according to Pankaj Chitanglia of First Basis, this year will belong to dollar bears, and the dollar index could be capped around the 104 to 106 levels before falling below 100. While there is a mild upward bias in the USD INR in the short term, it is likely to be capped. The resistance level is 83.35 in the medium term. The pair should go towards 82.5 in the back of weak dollar index and the possibility that the US would lead India on timing of interest rate cuts.
All right, and on the bonds, Neeraj Gambhir of Axis Bank says the Indian 10-year benchmark traded in a range of 7.14 to 7.19%. For the week, bond yields retracted higher on global cues as markets paired rate cut expectations on stronger US retail sales and UK CPI data. The SDL auction size was also higher than planned. Going forward, the market would look for FOMC rate decision and government borrowing plan in the upcoming union budget. He expects the 10-year benchmark to trade in a range of 7.1 to 7.2% for the week ahead.
Well, a lot of stock-specific action that we're going to be tracking for you. We'll get to that in just a bit in our special top 10 segment. But we're looking at Axis Bank, Pidilite, L&T Finance, Tata Elxsi and Sona BLW Precision. All of them will be reacting to positive news flow. Add to the list, MGL on the positive side, while on the flip side, United Spirits, Karnataka Bank, JSW Energy and Havells will be reacting to negative news flow.
Okay, well, let's get some flow picture now. We have Cameron Brand, Director of Research at EPFR Global, joining in. Cameron, good morning. Great to have you with us here on CNBC-TV18. We will just discuss. I'm not sure if you're familiar with these new rules of the SEBI. Essentially, what our market regulator SEBI wants is it wants foreign investors to disclose their end beneficial owner. A lot of money in India comes through instruments which are called participatory notes, P notes, and this is the route which perhaps gets impacted the most. Now there are threshold. There are sort of 2 or 3 factors which have been defined by the SEBI above which you have to disclose. I'm not sure if you've heard of it. If you have, any thoughts you may have?
I've certainly heard of it. I've been sort of doing this long enough to, regard this almost as sort of that there are periodically initiatives within Indian financial regulation that sort of worry foreign investors. But as I understand it, there's several months before it's implemented. And honestly, I think if the effect looks too painful, historically, there's some moderation. At least at the moment, it really hasn't impacted, the flows to the India-mandated mutual funds. They aren't taking in money at quite the same torrid pace they were, especially in the second half of last year. But that moderation had already started before Christmas. And that said, we're still seeing very consistent inflows into the dedicated India funds. We're certainly expecting a fairly bumpy first quarter for really most asset classes. There's a major slate, as big a slate of important elections as certainly I've seen in many years. There is the sort of back and forth on when and to what degree the European Central Bank and the Fed will start cutting interest rates, and obviously the geopolitical tensions in the Middle East. So even though I think from where you sit, it looks very concerning, especially when linked to some of the FII outflows you've seen recently, I would be disinclined to put too much weight on it just now.
The point is, if you are inclined enough to stay in a market, you find a way around it, Cameron, right? We've seen that in the past. I mean, these things, as you said, have come and gone, but maybe in the very near term, we just need to watch. I mean, on a day-on-day basis, yeah, I mean, sure, it can influence flows, etc. But take your point, Cameron. Sonia.
Cameron, hi, good morning. You started by also saying that, there's a lot of money being put into the Indian markets, and that's something that can continue. We have a big event upon us, which is the union budget as well. It is a vote on account, but there will be a full-blown budget in July. From an investor standpoint, do you have any expectations? And do you think the money will continue to flow in irrespective of what comes through?
I think, the people certainly pay attention to the budget, and, if there's a real horror lurking there, you'll see a reaction. But what we're also seeing, certainly over the last few months, is sort of a very granular approach to investing, certainly through mutual funds, country-specific rather than regional. In some cases, really sort of down to baskets of a few preferred stocks. For India, I think that's to the good. Within the emerging markets universe, really, you remain sort of one of the better stories. The market run up last year was sort of crying, I think, for a correction, which you're starting to see. But the combination of demographics, decent growth, stable politics is very attractive to investors who want some emerging market exposure and are looking over a landscape where you can find pretty serious drawbacks and issues wherever you look.
Hi, Cameron. Good morning. Cameron, I had a broader question, though. The Fed has suddenly sounded a little bit skittish, and, maybe in the last 7-8 days or so, from expecting cuts, and expecting at least a quarter percent point cut from March, that probability has fallen. So have you seen outflows from emerging markets itself? That could explain some part of the selling that we're seeing in the Indian markets.
What's been interesting, certainly in the first 3 weeks of the year from a fund flow perspective, is how similar it is to the patterns are to what we were seeing sort of in the month leading up to Christmas. Emerging markets flows in aggregate are positive, but they rely very heavily on investor interest in a number of major emerging Asian markets, of which India is in the top 2. And I don't think, though the sort of market reaction to the dovish tone of the Fed meeting in December was very strong, that reaction was pretty short-lived within the mutual fund space. People started kicking the tires quite quickly and scaling back their expectations. So, I think that we will certainly see some rate cuts in the first half of the year, but it might not be in March. There's enough variables. American consumers still have quite a bit of cash available, piled up in liquidity funds, which took in $1.2 trillion last year. So, they can swim against the interest rate tide a bit longer if they choose. So I never thought it was a given that the Fed would cut that early, and I think quite a few people have a similar view.
All right, Cameron, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC TV18. Let's slip into a quick break. Lots of stocks in focus. Axis Bank will be reacting to its numbers. Some disappointments there. More on that coming up in a bit. Stay tuned. Welcome back. Plenty of ground to cover in terms of earnings. Let's get straight to it. Abhishek is joining in first up to tell us about Axis Bank. Abhishek, some pressure seen in the numbers this time?
Well, the key highlight would be deposit growth. 5% sequential growth is not seen with any other bank. Otherwise, it's an operational weakness seen in the P&L. So deposit growth was 5.15% on a sequential basis, which is the best among other private peers like, ICICI Bank, IndusInd Bank, Kotak Bank or SDFC Bank. YOY, the deposit growth is at 18.5%, perhaps the best that you are seeing in last 8 quarters, largely driven by wholesale deposit, which has come in at a cost. So watch list now stands at 0.54%, which is the lowest in last 8 to 9 years. X of Q2 FY24 slippage ratio is the lowest in last 12 quarters. 33 quarter low in terms of gross NPA and net NPA ratio. On the flip side, negative from the results is that the overall operating profit declined YOY, perhaps for the first time in last 6 quarters. The core operating profit growth is the weakest amongst peers, whether YOY or quarter on quarter. So YOY, the core operating profit is actually flat or 0% gain over there versus all the other peers are showing a gain of anywhere between 6% to as high as 32-33% for Kotak Bank. Sequentially also, the core operating profit growth is amongst the weakest in terms of comparison to peers. 5-quarter low in terms of net interest margin. They had grown wholesale deposit this time around, so that impacted the margin. CASA ratio, which is an industry phenomenon wherein all the banks are losing CASA, is at 14-quarter low. In terms of PNL, both the NI and PAT have met our poll. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Mangalam. Mangalam, Pidilite's numbers good enough?
Very good. In fact, these would perhaps go down as the results of the season of the FMCG sector this time around. Fevicol ka jod, strong operational beat. Consumer volume growth came in at 10.3%. The street was working with a number of around 8 to 10% itself. But the most important thing was the sharp expansion that we saw in gross margins. 1,100 basis points improvement in gross margins, as a result of which the EBITDA of the company jumped by 50% and the net profit jumped by 66%. So that was no mean feat. The gross margins at 52.9% is at a multi-quarter high, if not a record high as well. And the management commentary was also rather positive. They said for them, rural and small town markets actually outpaced urban growth. 9 plants for the company have been commissioned this year, 1 in this quarter itself, and they've continued to increase their distribution touchpoints across India as well. And add to that, the stock was down 6% in yesterday's trading session. See a case for a bit of an up move in Pidilite today.
All right, Mangalam, thanks very much for that. Well, let's come back to Abhishek now. L&T Finance reported numbers as well, and it was a good set, isn't it, Abhishek?
Well, it was a strong set of numbers coming in from L&T Finance. Look at their net interest margin. It's at all-time high, driving a 16-17 quarter in terms of high ROA and ROE, as well as the fact that asset quality is the best in the last 8 to 9 years. Take a look at the gross NPA. It's down 14.3% quarter-on-quarter. Gross NPA ratio and net NPA ratio at 2.95% and 0.64% are perhaps the lowest that you are seeing in the last 8 to 9 years. Disbursements are up 13% YOY and 8.5% sequentially. The AUM is down 7.5% YOY and up about 3.9% sequentially. The D-focus book is now at 0. So all the momentum that you'll see from here on will be on the focus book for them. Net interest margin is at all-time high of 8.97%, which compares to 7.4% in the same quarter last year and about 8.6% in the previous quarter. ROA, return on asset, is at 17-quarter high of 2.53% and ROE of 11.35% is perhaps the best that you are seeing in last 16 quarters. In terms of the PNL, NII was at 1,833 crore. Kotak Securities was estimating around 1,815 crore. The PAT was at 640 crore versus Kotak Securities' estimate of 588 crores. Back to you.
All right, thanks a lot for that. A stable set of numbers coming in from Tata Elxsi this time. Rima has the fine print. Rima, over to you.
Hi, good morning. As you said, stable quarter for Tata Elxsi. The company's reported a revenue growth of 3% on a quarter-on-quarter basis. This is lower compared to the 3.4% that we had in the prior quarter, but Q3 is a seasonally weak quarter. But you can see the acceleration compared to, say, Q4 of last year or Q1 of this year, when the revenue growth was about 1.5%. On a year-on-year basis, revenue growth has come in at 9.4%. Margins have dropped sequentially, but that's on expected lines, and the company has reported a profit jump of 6%. In the conference call, the company sounded upbeat on transportation vertical, which is about 45% of their revenue, picking up. There are deal ramp-ups which will boost the revenue growth in the subsequent quarters, though media is having a bit of a challenging time. But on the whole, steady set of numbers. Back to you.
Okay, all right. Well, getting back to Mangalam. Mangalam, what about United Spirits? Cheers or not quite?
Well, there were cheers. In fact, cheers all around. If you look at United Spirits, the revenues were largely in line, led by the Prestige segment. Strong EBITDA performance. The net profit also jumped by about 60%. And if you take a look at the reported numbers, across our expectations for the revenue, EBITDA, net profit, that was a healthy beat. The only thing is that, the beat was led by their Prestige and above business, which was at the higher end of street expectations. Revenues up 10%, street was working with a number of 7 to 10%. Volumes up 4.6%, the street was working with a number of 3 to 5% itself. Realization per case also improved by 5%. What wasn't good was the popular segment, and we've seen this weakness in the lower end of the consumption spectrum, where the volumes contracted by 23%, and the management has alluded to the weakness out there as well. They said that QOQ demand momentum was relatively muted. Even though the premiumization trend continues, they remain cautiously optimistic on growth. So while the numbers were good, slightly impressive on the operational front as well, the stock is at a record high, and the management commentary may lead to some profit booking, so which is why I'm going with a red on United Spirits.
All right, thanks a lot for that. Going with the red on United Spirits. We're going with the green on Sona BLW. The numbers looked very good in this quarter. The revenue growth was almost 16%. The margins have gone up 360 basis points year on year. In fact, in the conference call, the management has raised their margin guidance. They now expect margins to remain at 28% in the near to medium term versus an earlier guidance of 25 to 27%. More on that later. But if you look at it, the core EBITDA as well has gone up about 32%, coming in at 233 odd crores. And now the company is increasing their presence further in the electric vehicle segment. Out of their entire revenue stream, almost 30% of their business now comes from the electric vehicle segment. And the 9 months FY24 BEV, which is the electric vehicle segment revenues, went up 31% at 613 odd crores. So I'm going with green on Sona BLW. But let's go back to Abhishek. He's also tracking Karnataka Bank this morning. Abhishek, how did it look?
Weak numbers, Sonia. So to begin with, sharp deterioration in asset quality. Gross NPA absolute value up 9% quarter on quarter. Net NPA absolute value up more than 19% quarter on quarter. We don't have the slippages details as they have not been given in the presentation. Deposits are up 9% YOY and about 3% sequentially. Loan growth was about 9.6% YOY and about 3.5-4% sequentially. Net interest margin contracted sharply by 35 basis point YOY and 17 basis point on a sequential basis to 3.46%. NII declined by 0.9% YOY and was up 0.6% sequentially. The PAT growth was at 10% YOY and about 0.25% sequentially. And the bank will also hold a board meeting on 27th to consider a fundraising approval from the board. Back to you.
A weak set of numbers here. Abhishek, thanks for that. MGL is the next one which reported numbers. Sonal is here with details on this one. Sonal.
Good morning, Prashant. It was a beat, a margin-led beat at that, and it was a good performance from the company. It beat estimates on all the parameters. Revenues came in at 1570 crore rupees versus a poll of 1514 crore rupees. Operating profit margins at 28.6% versus a poll of 27.8%. Net profits also higher at 317 crores versus a poll of around 297 crore rupees. The volumes, they were in line with estimates to come in at 3.7 MMSCMD, but it was a growth of 8% on a YOY basis and 3% on a sequential basis. So there were worries about volume growth for CNGs, but looks like it has come back. EBITDA per SCM was slightly lower than the street estimates, but it is coming in from a very high level. Jeffrey says third quarter EBITDA was 19% ahead of their consensus. They will look for the management guidance on volume gains, post OEM partnership and trajectory of APM shortfall going forward. The conference call is at 4:30 p.m. today.
Got it. Thanks a lot for that, Sonal. Well, let's wind this down with Vivek, who's back, and he's going to tell us about JSW Energy. Morning, Vivek.
Well, good morning. So JSW Energy, on an absolute basis, year on year, the numbers are quite strong. However, when you're comparing it to the sell-side street estimates, it's slightly softer than what the street was anticipating, which may weigh in on the stock performance today. So when you're talking about the overall revenues higher by 13.5%. So what's actually aided? Strong generation trends. So generation up 43% on a year-on-year basis, aided by the new acquisitions actually kicking in, and also higher capacity from the renewables portfolio. When you're talking about the thermal performance, quite strong from the company. Buoyant merchant market has gone ahead and aided the thermal performance of JSW Energy. EBITDA higher by 78% on a year-on-year basis. Margins at 43.7%. However, when you're talking about margins, it was slightly offset by some of the fact that the low raw material cost for thermals was something that the company benefited from. Net profit higher by 29% on a year-on-year basis. However, this was impacted due to higher financing costs from the Mitra portfolio as well as higher taxes. So expecting a slight softness as far as JSW Energy is concerned, given the strong run-up and also the high valuation that the company trades at.
All right, Vivek, thanks very much for that. Let's focus on Havells now. Upasana is here with details on this one. Upasana, hi, morning.
Well, Havells India reports its Q3 FY24 numbers, and the numbers were below our estimates. The revenue saw an uptick of almost 7% on one-year basis and 13% sequentially, which was below our poll estimate. Coming to EBITDA margins, they were down about 50 basis points and stood at around 9.80% versus 10.30% on a one-year basis, while we were working with a poll of 10.40%. PAT stood flat on one-year basis at 288 crores, which was again below our poll estimates. While the company's biggest cables and wire segment saw a revenue uptick of almost 11% on one-year basis and 7% sequentially. Now, coming to the EBIT margins of this segment, it stood at 10.40% versus 11% on one-year basis, with a downtick of almost 60 basis points. While the company says that the consumer demand remains subdued, though recent trends suggest some kind of recovery. The infrastructure-led demand remains robust, supporting cables and professional lighting segment. Well, they see a healthy growth in professional lighting segment, while consumer lighting is still impacted by LED price deflation, is what the company has indicated. Now, coming to Lloyd, the company aims a 2-year growth of almost 18% CAGR, and it says that the growth levers remain intact for the coming season.
All right, Upasana, thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Axis Bank, Pidilite, L&T Finance, Tata Elxsi, Sona, BLW and MGL. While stocks with negative news flow, United Spirits, Karnataka Bank, JSW Energy and Havels. But let's also get a grip on what's happening in the world of commodities. Manisha Gupta joins in for a roundup of all the action there. Manisha, good morning.
Hi, morning, Sonia. For that, well, I'll start with the crude oil prices, which are trading off the highs. Remember, we did see the prices gain up by 2% on Monday, and this is after Ukraine drone strike against a major Russian fuel terminal. Since then, it really has been consolidating. So you have both the varieties trading below $75 or $80 a barrel for Brent as well. As of now, markets are looking at supplies coming back. So the Libya is restarting its production at the Sharara oil field. There also is output recovering in North Dakota after that winter storm. And then the street is watching out for a possibility of China considering $278 billion of a rescue package. If that comes, you will be looking at better demand for commodities and, of course, a support to the equity markets as well. Apart from that, you have the U.S. PMI data that comes in today. The fourth quarter GDP numbers from US is tomorrow. The European Central Bank monetary policy also happens tomorrow. So markets will take cues from all of these as well.
All right. Thanks a lot for that. Well, let's do one thing. Let's take a short break. On the other side of the break, Sri Krishnan H of Karnataka Bank will be joining in for their Q3 earnings. Stay tuned.
Welcome back. Hope you're having a good morning. Well, Zee continues to be a stock that's going to be in focus, and Zee's promoter, Subhash Chandra, has written a letter to the Finance Ministry on January 16th, blaming SEBI for scuttling the deal with Sony. Nisha joins us to fill us in with all those details on that front. Nisha?
Thank you so much and good morning, Nigel. Well, Zee promoter Subhash Chandra, after the fall of Sony deal and a colossal loss to the company, lashes out at the market regulator SEBI, and in a letter to Finance Minister Nirmala Sitharaman, Chandra questions the timing and urgency of the SEBI investigation against the promoters in a matter that has been already in the company's records for a last few years. Now, he seeks Finance Minister's intervention to safeguard the interests of minority shareholders and also points out the loss of $1.5 billion of FDI that would have come by way of this particular transaction. Now, to support his argument, he did mention that SEBI may be acting with predetermined mind, and to support this, he invokes the para from the SAT order, which was a big victory for Puneet Goenka against the SEBI's order, which was an interim order for taking away his KMP position while the investigation is on. And SAT had overturned the order, and the SAT bench had pointed out that at this particular case, the SEBI chairperson committed a manifest error in confirming the ad interim order on the grounds of presumptions. So many of these points have been mentioned by Subhash Chandra, invoking and seeking Finance Minister's intervention in the SEBI's investigation and the timing of it, which he is indicating has scuttled the large transaction with Sony.
All right, Nisha, thanks a lot for putting all of that into perspective for us. That is the latest as far as the Zee-Sony saga is concerned. But let's move on. Karnataka Bank is the first management on the show today. The bank actually reported a sharp rise in gross NPAs and a much faster rise in net NPAs. So asset quality is definitely under pressure. Loan growth has not translated into net interest margin improvement either. It's peculiar because this comes at a time when a lot of the other banks are posting improvement in asset quality and loan growth. So let's find out what's going wrong. Sri Krishna Nech, the MD and CEO of Karnataka Bank, joins us now to talk about that. Mr. Sri Krishnan, thanks a lot for joining in. There is weakness in your asset quality. So first, if you can help us with the slippages number. What was it in this quarter? Has it gone up compared to the preceding quarters? And what is the outlook as we move into, Q4?
Thanks for this opportunity. Good morning. I think, we need to put things in perspective. The total profits, which is the PAT for the bank, has increased substantially, which is about almost a 25% growth on a year-on-year basis. So we are actually clocking a 9-month all-time high of 1,036 crores. So this is something that you need to keep it in the backdrop while we are looking at the other numbers, because this is a legacy bank and the new management has taken over. And obviously, there are lots of changes that we are making, and including in the overall asset book. The asset book, as you are aware, had a restructured portfolio post-COVID of almost 4,500 crores. We had brought it down to less than 2,000 crores. And currently, as I speak to you, this quarter end is about 1,800 crores. The slippages are about 0.8%, which is higher than the last quarter or even perhaps earlier. But this is primarily from the restructured advances book, which is all fully provided for. The other reason is very simple, that a lot of these restructured assets from standard are either getting into NPA or getting regularized. So this is a constant process, very continuous engagement that we are having with all our customers who are in this kind of, let's say, stress. And this is all post-COVID. And we will be in a position to kind of really clean it up. The overall number, compared to the 70,000 crores of asset that we have, and we've grown the loan book this time substantially at 18.5% on a year-on-year basis. And this again stands at close to 70,000 crores, 69,740 crores. So which means the percentage
Mr. Sri Krishnan,
yeah,
you said 0.8%, right? So just can you quantify that for me? How much is the absolute amount of slippages compared to, say, last quarter? And also, which are the sectors or segments where you saw higher slippages? Yeah, please go ahead.
So the total slippages amount is 255 crores, which is, additionally from the restructured portfolio. Otherwise, the NPA levels, we are actually reduced. The net NPA has come down by about 10 basis points and the gross NPA has also come down by about 8 basis points. Overall, the book is steady. So this is a historical book, and there is also the new book. The new book is growing. The historical book we are compressing. Now, on the overall provisions, we are at 80% right now. We were at 83, and we have provided for all of this slippages that are happening. And last but not the least, including our technical write-off, we are still closer to 60%, which is also a very healthy, steady state of the book.
All right. Hi, Mr. Srikrishnan. Good morning. Nigel on this side. It's a couple of numbers. The gross NPAs, as I see it, of the last quarter is around 3.6%, and the net NPAs is around 1.55%. What is the outlook out here? How do these numbers shape up?
So the outlook is that in the next 2 quarters, we should be aiming to get the gross closer to the 3% range and the net NPA to the 1.2, 1.25 range.
Got it. All right. And what about deposits? Deposit growth has been a little bit weakish. How do you see this number moving up? If you could give us a broad growth outline.
This is a common factor across all the banks this quarter, as you know. Low-cost deposits.
Right. But sir, you will have to innovate and come up with something new, right, to try to shore up your deposits. So do you have a plan in place, and what's the outlook? Go ahead.
Of course. So we have a chief product officer in place. As of yesterday, we have a chief information officer also who has joined. And the digital bank that we are setting up to acquire deposits through collaborations, through fintech collaborations, etc., is going on in full swing. So the branch franchise is also going on in full swing. So there is an outbound sales team that we have deployed, which is more than about 500 feet on street and plus 250 sales officers from the bank. We are also making sure that the incentivization plan for them to acquire new accounts and also cross-sell and upsell for the existing to bank accounts are being made. So with all this, I think that the outlook is very, very positive. And more importantly, I think that the growth in advances led by the MSME and the SME. And the second is rural and agri is also growing. Last is that on the deposit side, the branches are really kicking in right now. All the branches have been turned into a sales.
Mr. Srikrishnan, good morning. Prashant here. You got a board meet on Saturday for fundraise. Could you tell us more about that?
Yeah, we had a board meeting yesterday, and we have notified that we have another one on 27th. You are aware that the board had approved a 1,500 crore capital raise. Out of that, 800 was already done. We are looking at options for the balance 700 to be raised, and which is why the board is meeting. We did not want to do it yesterday along with the quarterly results. We're also happy to announce that we have appointed one more additional independent director who comes with a very, very professional background. We have strengthened the board. This will be in lieu of one of the erstwhile directors whose term is ending. And
which way are you leaning, sir, in terms of route for the fundraise?
So we will be looking at a combination, which will be something that we will declare on the 27th.
Okay. Can you just give us one number on the loan growth by the end of the fiscal and FY25? What is the expectation? What would the loan growth be?
18% is what I have stated, and we continue to grow at the same 18% for this exit of March, and also the 3-year outlook that I have given, and we stay by that.
All right. Well, thanks a lot for joining in, and appreciate your time here on CNBC-TV18. That's Karnataka Bank. 18% loan growth is what they're looking at by the end of the fiscal. But Anuj is back in town and back here in our studio to give us a quick trade setup. Anuj, morning. Hope you prayed for all of us, including praying for yourself. But great to see you and that coverage there. For the markets, I think prayers are much needed now.
Morning, Sonia. Thanks a lot. Yes, indeed. Prayed for the entire family. And of course, it was a divine time over there. Coming back to the market, you'll remember about a week back or so, we had put some caution on table that there were telltale signs that this market now needs to correct, and correct big perhaps. What is this correction? Basically, some kind of flushing out within a larger trend. The larger trend is still up, but the corrections in larger trend can be brutal, like we found out over the last 1 week. Now, there are two issues which need to be addressed. First is HDFC Bank, because that's really been the primary reason for this correction which started. HDFC Bank hit 52-week low yesterday, and it's seen delivery volume of 25,000 crore since results, 52% FII holding. So suffice to say that a lot of this has been from the FIIs, and that's one reason that the Bank Nifty has been doing what it's been doing. HDFC Bank alone has accounted for 2,500 points of Bank Nifty's fall. That's what happens when an index is lopsided. I mean, it's like a double-edged sword, right? It works when it's in your hand, and it can cut you back as well. Now coming to the mid-caps, they had a one-way rally, and the only thing driving rally in a lot of stocks was just liquidity. I had given an example of Previk, for example, the kind of rally that it had seen, and the stock had become, 100 times. Many mid-caps had reached 100, 200 times PE, and there were enough signs that some of these would correct. Now coming to the setup for the day and for the Nifty and the Bank Nifty, I think the next level to watch is the 50-day moving average, both simple and exponential. They are placed very close to each other, 2971 and 21,083. The texture has been very clear. Sell-on rally has been working in this market. On the Bank Nifty, I think the next level to watch, and it's a very important level, is the 200-day simple moving average, and that's placed at 44,666. If 44,666 is broken, then another 1,000-point downside opens up. But in between, of course, you'll have short covering bounces, short covering rallies as well. But the texture clearly on the market has become quite weak of late.
All right, 44,666, 44,600. So it's, I mean, lots of supports in that zone. 44,600 is also the 61.8% retracement of that full rally from the October lows to the December highs, all-time highs for the Bank Nifty. Anush, thank you very much for that with that trade setup. We'll take a quick commercial break here. On the other side, Mitesh and Sudarshan will be with us with technical trading ideas. Stay tuned. That's coming up. Okay, welcome back. We got, 9 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with what they're making of things as we begin another trading day. Gentlemen, great to have both of you here. Thanks very much. Mitesh, the fall yesterday became a bit large in the last hour or so, 1.5% gone. The GIFT Nifty is indicating a bounce, but would you trust it to be able to take long positions on that bounce, or you think it'll fizzle?
Morning, question. The initial sense is that I think it will fizzle out. With the fall and the big candle, which was a red candle yesterday, a lot of indicators have turned negative, which means that the directional bias should be on the downside in the slight short term. The level which I'll watch on the upside is 21,350 on this spot, which is about 112 points higher from here. And in case we don't show strength to get past that, then I think it will be calling for some kind of immediate action on the downside, which could be buying into put options or selling call options. Otherwise, we'll see if there's some strength beyond that level, then we'll see how far we can go on the upside. But I think overall, we will possibly make slightly lower lows from here. The levels which I'm watching is the earlier consolidation phase of 21,000 to about 2950. That should be a target which the Nifty should do in the next few days, and maybe lower, but I think we'll start with this target.
All right, Sudarshan Sukhani is also with us. Sudarshan, how do you feel about this volatile market, and what do you think will explain the kind of fall we saw yesterday? What's the outlook now?
Yeah, good morning. See, I feel a little troubled about this volatile market. In the beginning of January, I had suggested that we will see choppy markets throughout the month. That's exactly what's happening. Higher levels are being sold into. That tells me that the decline has not come to an end. We had a discussion earlier whether it's a correction or a dip. It was a correction. This correction is likely to see 20,500 probably. Obviously, no one knows for certain. So there's a lot more downside here. So the trade is that if you see a rally, you try to build short positions by buying put options. There's no sense in trying to buy this dip. This market, as Anuj earlier said, is a sell on rallies market for both the Nifty and the Bank Nifty.
Okay, all right. Sell on both the key indices. Sudarshan, but tell us about your individual stock trades for the day.
Well, Bajaj Auto is an outperformer, as Hero MotoCorp was yesterday. So that's a buying opportunity with a stop under 7,005. Escorts is an intraday short. The stock, for some reason, it's falling consistently. Stop above 2885. It's only intraday short. PI Industries is another intraday short. Stop above 3340. And Siemens is outperforming. It doesn't mean it will go up. It just means it's better than the Nifty. Buy with a stop under 4,040.
All right, Mitesh, what about you?
So I have slightly more bias towards the negative side. Cipla is on the buy list. 1390 being the stop, 1450 being the target. Rest, I have a sell on IDFC on a pullback. Let's say if we get it around 118, keep a stop at 122, look for targets of 110. And two conditional sell calls. If they start trading below yesterday's low, then I think a sell on MCX will be activated if it breaks the pivot of 2990. Keep a stop at 3035, look for targets of 2,900 or below. And Bharat Forge, similarly, if it breaks below 1185, take a shot with a stop at 1202 for targets of 1150.
All right, let's step into a quick break on that note. On the other side of the break, we'll talk more about the markets. We have a big day lined up. The pre-opening rates are going to kick in. Also, Krishna Prasad Chigurupati of Granules India will focus on their Q3 earnings. Stay tuned. Welcome back. You're watching Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Well, Rajesh Palvia of Axis Securities is joining in now to give us his view on the F&O market. Rajesh, hi, good morning. This has been a very volatile market, and after the sell-off we saw yesterday, what's the outlook today and what are the stocks to look at?
Good morning, Sonia. So, looking at the sell-off in previous session, we believe that further more pressure is likely to be there in the market as both indices have witnessed a long unwinding on the derivative data front. Even on the call concentration, put concentration data is clearly suggesting that most of the call writers are now aggressive at 21,300, 21,400 strikes. So that clearly shows that upside is capped at 21,300, 21,400 range at this moment for this weekly expiry, for this monthly expiry. So we believe that if we breaks below again 21,200 mark, then possibly this supply pressure can continue towards 21,000 level. That's the next major support area based on the put concentration for Nifty. So we believe that one should adopt the sell on rise kind of strategy for next couple of trading session until the Nifty not manages to cross about 21,500 again. For Bank Nifty, the major breakdown has happened almost for this month. We have seen significant sell-off for Bank Nifty and almost down by around 7.5% compared to month-on-month basis. So that clearly shows that there is a more weakness is likely to be there in Bank Nifty, and possibly if we remains below to 45,000 mark, then possibly Bank Nifty can slide further towards 44,500. That's the next level we can see in the next couple of trading sessions for Bank Nifty. So both indices are looking weak at this moment. To initiate this down move of Nifty, we are initiating here to buy put option for 21,200 strike that was closed at around 111. So one can buy this put option in range of 111 to 90 rupees and keep your stop loss of 55, and on the higher side we are expecting target of this put towards 150 to 160 where one can book profits. On stocks front, Bharti Airtel is looking promising, clearly outperforming stock for this series. Towards the expiry, we expect another round of buying action could be there in Bharti Airtel. So one can buy Bharti Airtel for upside target of 1185 to 1195 with stop loss of 1140. The stocks which we feel that can go down, that is Bata India. There is a breakdown in the stock. A short built up was there. Looking at the structure, we believe that Bata India one can go short for downside target of 1420, 1400 with stop loss of 1485. And another stock where one can go short, that is Jindal Steel and Power. Stock now break below to 20-day, 50-day moving average. And looking at the setup, we believe that Jindal Steel and Power can go down further. One can go short for downside target of 665 with stop loss of 710.
Okay, all right. Thanks a lot for that, Rajesh. Well, let's focus on a couple of companies then that came out of the set of numbers. Granules India, that's a stock in focus. The company reported a flattish revenue, but margins recovered to 10-quarter highs. And that's something that the street liked. During its conference call, they indicated that growth will revive from FY25 onwards. To discuss this and more, we're joined by Krishna Prasad Chigurapati, the chairman and managing director of the company. Hi, sir. Good morning, and thanks so much for joining in. First of all, good to see that your margins have recovered to 10-quarter highs, so thumbs up on that front. Tell us what's the trajectory going ahead? Will the focus be more on profitability? If yes, then do you end FY24 flattish? And what's the growth estimate you have for FY25 with a broad margin outlook?
Good morning. Yes, this quarter we had very good growth in gross margin. This is mainly because of the new product introductions and from India and also from the US. Our US products, especially in the controlled substance space, have picked up and they do contribute to healthy margins. So we do expect this to continue. And as we launch more and more new products, we expect that we should not go down on these margins and we should be able to maintain these margins.
Margins
and
will
looking
be maintained?
at
Growth?
this year will be sort of flattish, but next year we do expect decent growth with introductions of new products and also some new capacities coming up in first phase of a new formulation plant. We expect to see some decent growth and it'll be decent, that's all I can tell you.
Okay. Mr. Chigurapati,
margins will be maintained.
Okay. I think the word decent differs, right, from person to person. But let's talk a little bit more about the US markets, because you've seen almost a 21% growth year on year. But quarter on quarter, your US business has slipped about 5%. Are you still facing any pricing pressures in the US? If yes, what do you think the average run rate could look like over the next few quarters?
We expect there is pricing pressure. Some products we have to take price hits, but some other products we were able to, new products especially, we were making up. And definitely we will be able to maintain this ratio and slightly keep increasing them. In the short run, at least for next year, we expect that US business is the one that will contribute to our growth, followed by Europe.
Okay. Oh, that's interesting that you're saying that Europe will contribute to growth, because Europe saw a big decline this time, almost 16% decline. And, you know, the API business across the board has been under quite a bit of pressure as well. So you're confident that things will improve in the quarters to come? And if you can just give us the situation on the ground in Europe right now?
Europe was mainly a paracetamol market, API market. And we were trying to get into the FD space, and we did. We have many approvals already, and we are launching one by one of the finished dosages, licensing different people in different countries. So the paracetamol prices, which in the last few years were very high, had come down. Also, our raw material prices have come down. So that's the main reason for fall in European business. It will slowly keep growing with FD business, which are more profitable than the API business. Also, in addition to the price fall in paracetamol, which led to a lower revenue, when also some of the paracetamol and other APIs we had, metformin and other things, we are using them more and more for our finished dosages and PFIs. So it's cannibalizing on our APIs. And this is as per plan. As we go by, FDs will take over more PFIs and APIs too.
All right. You know, so what's encouraging is not just the margin improvement, but the cash flows as well have improved. So that's good news. Now, could you give us an outlook in terms of debt? You have some expansion plans that are coming on stream as well. The last recorded debt, I think, was around 930 crores. What's the outlook from here on?
We should be able to actually, if not for the first 2 quarters, our debt position would have been far better. So we were able to maintain our debt. So that's a good news. And going forward, we will be bringing it down in spite of the capex. Only thing is, as we increase, there could be a little extra requirement for working capital, but we should be able to maintain that.
All right, we'll leave it there, sir. Thank you very much. Good conversation as always, and we look forward to speaking with you soon again. Thanks indeed for joining us. The pre-open is now, I think, getting close to being settled. The rates should come up on your screen. I think you got, 200 points cut on the Nifty, on the Sensex, and you got about a 0.5% cut, less than 0.5% cut, which is about 80 points on the Nifty as well. So this is what's coming through, 0.5% cuts on the frontline indices, with I think about 2 minutes more for the pre-open session to come to an end. Now, one of the things which at the margin people have been talking about, and especially it picked up momentum from yesterday afternoon when the market started to sell off, was the SEBI rules which require FPIs to disclose their end ownership, beneficial ownership. That's a technical word for it. There's a deadline coming up, which is the 1st of February, by which when they have to disclose. But that is not, in a way, the hard deadline. You got time after that for repair and what they'd like to do. What those who don't want to disclose what they'd like to do. So there is time. There's an important issue. Lata is here, and she's been speaking with her sources with the market regulator. Lata, tell us more.
Yeah, actually, sources very highly placed and close to SEBI pointed out that the number of funds which were thought to be impacted by this rule, let me remind the SEBI rule that if one fund holds more than 50% in one group, then they have to disclose who are the ultimate beneficial owners, right up to the granular detail. And then there was the other one that, over 25,000 crore owning funds, which are in the border countries. Their exposure, they have to also tell us the final beneficial owners. Now, in the first rule, where this concentrated holding in one group was concerned, this source told me that originally the paper thought that about 2.6 lakh crore of funds would be impacted. That would be about 5% of the market cap of the total FII ownership in India. Now they think that it will be far less, when they go through the sieve. It may be probably at best 2.2 lakh crore. And they've also, the source also told me the list of people who will be exempted from it. Sovereign wealth funds are obviously exempted from it. Some listed companies own shares in India. They are also exempted because they would have concentrated ownership, but they're listed in their own countries. Also, publicly, funds which have a large public holding, those are excused. And other regulated pools of investment vehicles, which are regulated, like, say, in the SEC in the US, all those are also excused from having to provide the final beneficial ownership. Also, they are, giving a very free hand for those funds which have concentrated holdings in Indian companies which don't have an identifiable promoter. Like, for instance, HDFC Bank, ICICI Bank. There is no identifiable promoter, so there is no question of the MPS rule, the minimum public shareholding rule, getting sidestepped or price discovery getting, distorted. So if you own, say, all your 50% stake is in one HDFC Bank or ICICI Bank, again, they get a free pass. They don't have to disclose the final beneficial ownership. The other point that the source pointed out is that the SOP, the standard operating procedure which custodians follow to find out whether you come under this rule or not, was already available on the website of the custodians way back in October. So funds had all the way till February 1st to disclose. And after February 1st, they get 10 days to write to the custodian. So technically, you have time till February 10th. And after that, if they still qualify as those with concentrated holdings, they can sell down till, another 6 months. So technically, SEBI had started conversation, the consultation paper, etc., way back in June. They had time from June to another 6 months from now, which is about 15 months, to reduce their holdings. To blame it on 2 days, this source said, looks a little strange, because they had all the time in the world. Even the SOPs were ready from October 1st, and they're going to get another 6 months to sell down. So this source didn't see any connection between the SEBI rule and the selling that's happening.
The point is that if you want to be in a market in India and you've got 6 months, you figure it out. We've seen this happen in the past.
And you had 6 months earlier also.
Yeah, I mean, even there is 6 months. It's a fairly long period of time, and I mean, there are ways we can discuss this more as the day goes along. But Lata, thanks very much for getting us that. I think we're just ticking down to the market open. There's 4 minutes to go for the start. Sudarshan is with us, and so is Mitesh with their 9-10 calls. Gentlemen, good morning. Sudarshan, your calls, your trades?
Well, PI Industries is an intraday short with a stop above 33.40.
Okay. And Mitesh, what about you?
I'll go with the sell on IDFC around 118 for targets of 110.
Okay, I just want to point out a couple of stocks before we head across to Mangalam to talk about United Spirits. Axis Bank, by the way, is down almost 5%. So the street definitely is disappointed with some of the internals in the numbers. Keep an eye out on that. Very strong set of numbers from 4 companies this time. L&T Finance, Pidilite, Sona, BLW and MGL. So all these stocks should be up for you. L&T Finance is up 2%. Pidilite also holding up in the green. Sona, BLW as well as MGL, good set of numbers. But let's take it straight to Mangalam. He's going to talk about United Spirits and how that one looked. Mangalam.
Well, United Spirits, the reported numbers were above street expectations, led by an operational beat. So let's talk about some of the internals. The Prestige and above revenue grew 10%, again in line with street expectations at the higher end. The volume growth in the Prestige and above segments was up almost 4.5%. The street was working with a number of 3 to 5% itself, and the realizations also improved. What did not do well for them was the popular segment. That's speaking of the weakness that we're seeing at the lower end of the consumption basket, and also the company's own strategy where the popular volumes actually declined by 22% versus an expected 14 to 15% decline itself. The company said QOQ, the demand momentum was relatively muted. Even as premiumization continues, they remain cautiously optimistic on growth. Remember, the third quarter is seasonally the strongest quarter for the company itself. Macquarie has written, and they have an underperform call with a target price of 870 on the stock. They want to know from the conference call that takes place at 4 today whether the third quarter gross margin is indicative of ENA cost pressures. So any commentary on that will be important. The stock's opening up in the green. Let's see whether that sustains there or not, because the stock is already at a record high, and the management commentary is slightly shifty.
Okay, all right. Thanks a lot for that. Mangalam stocks opened up closer on 3.5% odd. But I'm looking at JK Cement, And there's a bull and there's a bear argument. But first, just to run you through the numbers look quite good. They had higher volumes, higher realizations as well, and lower costs. So the numbers that came in on Saturday were actually better than expected. Besides that, the current capacity is moving to around 22 million tons odd. But they laid out this roadmap where they're going to be moving to around 30 million tons. Now, Citi, they are the bear on this one. They have a sell rating out there, and they believe that risk-reward is not really favorable. Why is that? Because the stock is trading at $140 per ton on expanded capacity. They're saying other regional players are available between $65 to around $130 per ton. While Jefferies, they are the bullish argument out there. They have upgraded the stock. They've upped the target price as well. They've reported industry-leading volumes as well as profitability. And they say that this has happened for the second straight quarter. And they also say that it's happened in the past 2 quarters, but going ahead as well, they can continue to outperform on the volumes parameter as well. So they've gone ahead and upgraded their EBITDA estimates by around 5 to around 12%. So that's the bullish and the bearish argument on this one.
All right, we'll keep an eye out on that. But let's head straight to the market opening now, which looks like it's going to be a slightly tough one this morning. Given the kind of pressure we saw yesterday, there could be some more on the cards. So the Nifty is down about 50 odd points. No help from Axis Bank and HDFC Bank. In fact, those are the 2 biggest losers this morning, down about 5 and 3% respectively. And then you have companies like Hero MotoCorp, Bajaj Auto that are slightly under pressure. Remember, there was large FII selling yesterday. There was over 3,100 crores of FII selling. And there was the first signs of capitulation in the broader markets yesterday. So that's something to be cautious about as well. A lot of stocks delivered good numbers as well. So whether it's Pidilite, Tata Elxsi, Sona BLW, L&T Finance, all of these may buck the trend this morning. But apart from that, looks like it's going to be a slightly subdued start, definitely, whereas the frontliners are concerned. There you have it. The first tick on the index is down about 50 odd points, 20 points now on the Nifty. So it's flat, but with a little bit of a negative bias. The Midcap's actually holding up in the green, up almost about 60 odd points. Let's take it straight to stocks that are in the news. Axis Bank is down 3.5%, posted its numbers. HDFC Bank has been hitting new lows, 52-week low yesterday. Today, the HDFC Bank is down another 1.5%. This year, we're not even done with January, and HDFC Bank stock is down 18% already. Massive wealth erosion over there with that stock, and of course the funds that own it. Bharti Airtel, Hero MotoCorp, Asian Paints, Power Grid, a couple of other stocks that are in the red. Bajaj Auto comes out with numbers today. The stock has been doing very well. Numbers will do well too, but I think perhaps a lot of that is in the price. So stock is down about 0.5%. M&M also slightly under pressure this morning. Now all 4 indices are in the red, but by a small amount. What's bucking the trend this morning? Hindalco, Coal India, ONGC, Adani, BPCL, Dr. Reddy's, Infosys is up about 0.7%, Wipro is up 0.7%, and Tech Mahindra is also in the green, up almost about 0.7%. But I think a lot of the action is in the broader markets this morning.
Well, that's right, Sonia. In fact, in the first tick itself, the Nifty Bank went ahead and broke the 200 DMA. And now it's bounced off that mark. So the 44,666, that's the 200 DMA. We breached that. Now we're holding with 50-60 points higher above that level. But the low of the day is below that. So the low of the day is around 44,490 odd. Keep an eye out on the Nifty Bank because, besides the numbers that are coming out, you have a technical factor at play as well. You don't want to go too much below that 200 DMA. For the time being, that number has got defended. What about stocks in the broader market? Well, plenty of stocks moving around. You have Zee Enterprises. For now, at least, that stock has bounced back in trade. Indus Stars, it's reacting positively to its number, so that's high with a gain of 3%. You have SAIL, that's up close to around 2% as well. That stock pulled back considerably in yesterday's trading session. Relicare, that as well, is one of the top volume movers today, so there are some stocks that are gaining from the broader markets. On the flip side, Oberoi Realty, after yesterday's cut, it continues to remain under pressure. Havells, the margins, the profitability is still under pressure. That's down close to around 2%. And Shriram Finance as well is down close to around 2%. Zee now, that's one of the top gainers out there. And Pidilite as well is bouncing up 3.5%. And for the time being, the bulls are winning over the bears on JK Cement because that stock's up 3.5%. Prashant.
Well, it's a 40-point cut on the Nifty. We're at 21,200. Zee is up 6%. I mean, Zee is bouncing with very, very large volumes. But this is just the first couple of minutes of trade. So, there's more to come here. We'll watch this one. But very large, noticeably larger volumes than the number 2 volume stock on the NSE right now. Pidilite, Nigel mentioned, it's up 4%. Indus Tower, we mentioned, 2.25% or so. Persistent Systems was up 10% when it started yesterday, ended with a 5% gain. It's up another 2% this morning. There is Religare, I think we mentioned this as well, 4% higher. Hindalco is up about 3.25%. Borosil Renewables went up about 15% yesterday. It's up another 2.5% right now. SAIL is up about 2.5%. There is ABFRL, which is up about 2. Jyoti Laboratories is up 3. There is Purvankara, which is starting about 6% higher. So, by the way, it's interesting. Look at the Nifty now. It's going a little bit more. I mean, we started about 40 points lower, pulled back 15 points, and now there's a fresh leg of selling. So suddenly down about 70, which is basically the day's low, the morning low, the few minutes that we've been trading, 21,158. The big support really is 2,900, and we'll see if that comes into view sooner rather than later. And broader market, suddenly it's flipped. It was almost 1:1, but now declines are noticeably larger as compared to what is going up. So about 1,200 stocks are lower and about 750 stocks are higher. So it's fast changing, really, the screen. So a few things on the downside. So the railway stocks are all pulling back. IRFC is down another 5%. Look at Axis Bank. Axis Bank is down 5%. So yeah, it's got large volumes. There is IREDA, IREDA. We had the management with us yesterday, 3% cut there. RVNL will come up on your screen. There's a 7% cut. IRCON is down about 4% or so. There is Railtel, which is down about 4% as well. Oberoi Realty is down another 4%. Oberoi Realty sold off 10% yesterday by close. There were numbers, of course, it was reacting to. It's down another 5%, as I said. Cochin Shipyard is down another 5.5%. Karnataka Bank is down 11%. You've got huge volumes in it. We just had the management with us at 8:30 in the morning, and Karnataka is, look at that, I mean, 1 million shares on it already. Mazgaon Dock is down about 3%. Cochin, Mazgaon, so yeah, I mean, there's again, PSUs is another common thread between all these names. CG Power is down 5.5%. So it's a large liquid name which is selling off. Shriram Finance is down about 2.5%. Hero MotoCorp is down about 2.5%. Tata Elxsi is down 4%. It'll come up on your screen. Stocks at about 70 at 40. And I could go on because it's a very active open right out of the gates with lots of stuff moving and moving fast with volumes as well. So there's no dearth of volumes, at least right at the word go, both on the way up and on the way down. And it's more on the way down today in terms of number of stocks which are moving. Manish Sonthalia is with us, Chief Investment Officer at MK Investment Managers. Manish, good to have you with us here. Are we getting into a bit of a risk-off phase, Manish?
Not so much on a global front, but I think this technical factor of beneficial ownership disclosure has set the cat amongst the pigeons, So technically, you have some levels to defend in the markets per se. And, broader markets and some segments of the market have seen a stupendous run-up. So you name some of them, the railway stocks, the defense stock. I would just call it a technical sort of a profit booking. Under-owned spaces will likely outperform, and these could be in the form of your technology or pharma or, some of the lesser-known banks, so on and so forth. But I would call it just normal profit.
Okay, just normal profit booking. Got that. The stock of the moment, though, is Pidilite. It's up about 5% Very strong numbers, as our colleague was telling us earlier, right? Volume growth of 10%. This morning, JP Morgan has upgraded Pidilite to an overweight. They've raised their target price to 2,900, which is a big upside to the current market price. Manish, how are you feeling about the consumption space now? I mean, we have very mixed numbers here, depending on which part of the basket you look at. But overall, do you think that this could be a space that comes back in 2024?
Consumer discretionary will likely come back in a big way, somewhat pre-elections and more of it post-elections. Not so bullish on the consumer staple space because valuations vis-a-vis earnings growth doesn't seem to be in sync. But some of the numbers that have come out of Pidilite or United Spirits seem to suggest that probably we are in an upcycle as far as the earnings trajectory on some of the consumer discretionary names would be there. So more bullish on consumer discretionary than staples.
Okay. All right. Hi, Manish. Good morning and good to see you in. Nigel on this side. What about the banking names? We got into 2024 saying that the consensus was buy banks and banks will do well. Now, post some of these numbers, some of these stocks have corrected big time. What's your preference from the banking space, and are you bullish on it?
See, if the earning numbers on FY25 and 26 have to come, banks really have to be contributing a large part of it. And there's no doing away from that because, they would contribute roughly around 1/3 of the total earnings growth of around 16% that we build in for FY25. Now, the stock price direction seems to suggest that either the markets are wrong about the earnings growth or there's significant P derating that is happening across the index heavyweights, that are there in the banks that contribute in the index. So the likes of an HDFC, ICICI, Axis, Kotak, so on and so forth. I think these could be on account of the beneficial ownership disclosures that, some of the foreign owned entities might be forced to sell. But clearly there's value on the table. I mean, as the P derating continues to happen, this basket or this space continues to remain a clear value buy, so to speak. Really don't know when the whole P derating story gets over, but either the total earnings trajectory on the index, Nifty, will not come at 16-18% if the banks don't contribute, or the P derating is somewhere closer to where we should be. Can't get derated too much from where we are today. So I would say that clearly it's a value buy, but the whole problem is that some of these known banks are massively owned by the domestic institution. Perhaps a full allocation that is allowed. So mutual funds allow 10% on individual stocks or ICICI Bank. Every mutual fund would file a 10% allocation. Similarly with HDFC Bank. So the leeway for fresh buying in some of these banks by domestic institutions doesn't seem to be. I mean, broadly, ballpark, maximum allocation. So it continues to remain a value buy, but that is how it is. Unless and until you see participation from the retail or the foreign institution, they continue to be laggards. But there is definitely value on the table in some of these names. I think the preference for, PSU banks is clearly out there. These are under-owned, and as far as the tailwind for the entire banking space is concerned, it's even for them, some of the numbers are very good, and the P multiples, etc., the valuations are, very, very palatable, so to speak. So greater value in PSU banks than private sector banks, and technically speaking, also, not so much of an overhang of over ownership. So continue to remain have preference for PSU banks.
Manish, on a lighter note, if you want private banks to do well, get retail excited, because foreigners, as you said, already all own it. And they've not been able to push them higher, but you get...
actually, domestic institutions own it full. There's not so much of, foreigners might be forced to sell because of disclosure. That 2.5 lakh crores worth of AUM that you require fresh disclosures. And I'm sure banking would be a major portion of their holdings since, in the benchmark, at one point in time, they were close to 40% of the total weightage to a Nifty would have come from the banks. So perhaps the buying would have to come from the foreign side in some of these private sector banks, because there's definitely value out there.
Yeah, Manish, since you brought up this FPI issue, have you been able to have you spoken with any of the foreign fund managers? Because I spoke to a few. They've said it's a real issue and they'll have to deal with it. But there are ways around it. So, for example, one of the criteria is that if you have over $3 billion of investments in India, right? That's a minimum. Then you have to disclose, which is 25,000 crore figure number. And most of this is going to impact people who come through via P notes. Now, people who provide you P notes, I mean, let's just assume an example. If there is entity X, a large bank which offers P notes to investors, and it is full up, it's got investments over $3 billion, and there's another one which is, say, at $1 billion or $1.5 billion, that can go up to $1.5 billion, right? So, the second entity goes up to the clients of the first one and says, well, you come through via us. So there are various ways around it, and there's 6 months' time. So would you agree with it? And any feedback you got, Manish?
Absolutely. If you see some of the recent, block deals that have happened in the markets, some of the P notes have exchanged hands. So obviously, what you're saying is actually happening in the market. And obviously, if a foreign institution has to get some exposure into India, and India can't be ignored for too long, you will have to find ways around it. And as far as my discussion with a few of them. I don't seem to, sense any major sense of panic as far as these regulations are concerned. And the regulations are there. I mean, look at it this way: if there was a selling that would have come from the FIs, we saw massive selling even during the COVID days, but it didn't really set off a panic. So whether the Indian markets are expensive or not is the key question. And at this given point in time, they are not grossly overexpensive. You may call them not very cheap, but not grossly over expensive. And India remains a bright spot in the whole global growth story. So I think there'll be ways around how to deal with this. But if there are new disclosure requirements from the regulators, one has to adhere to it. And how they are going to go about it, $3 billion, somebody has 1.5, additional 1.5. You'll see all sorts of P-note transactions via block deals that would happen in the market. I think that's the logical way that I see it. But I don't see any major sense of panic within institutional investors on the foreign side.
Okay. Manish, I wanted to come back to that point you were making about banks, right? Where you said that banks are a value buy at this point and you prefer PSUs. But what do HDFC Bank investors do? I mean, that seems like a value stock now. It's at a 52-week low as we speak. How are you feeling about that bank and what's the outlook?
Forget about the near term. If there was value at 1600, it becomes deeper value at 1400 and even bigger, deeper value at 1300, but it remains a value. So I think, it's the best owned, best managed private sector bank, a very large private sector bank, and the valuations just keep on getting better. So, I would believe that, leave aside the recent underperformance that you've seen in the bank, but it clearly remains a buy.
Okay, it clearly remains a buy. That's interesting. I mean, of course, you buy when the market is fearful, right? So that point is taken. What about pharma? Because, there is this increasing narrative that this year pharma will come back in a big way. The pricing pressures have gone down and stocks like Lupin are sitting at 52-week highs already. Are you interested to put more money to work here?
Absolutely an overweight position on the pharma space, clearly sector rotation. Pharma is one of them. And obviously, you've seen the numbers that have come out from some of these Ciplas of the world. And, you'll have Newlands and Alchems and Ipcas of the world also report good numbers. So I don't think that, valuations really capture the upside potential that is there in the pharma space. And if the earnings growth trajectory comes through, then there should be some PE re-rating also. So clearly an overweight position on pharma as far as I'm concerned. So, and that goes true even for the IT space.
All right. Manish, thank you very much for that. That's a good conversation as always here on CNBC TV18. Just a quick look at the market, which is, one thing is clear. There is a bit of indecisiveness. Very sharp moves in very short time span. We started 40 points lower, recovered. Then there was a 70-point sell-off. Then there's been a recovery. Then there was a sell-off. So all in all, net as of yesterday, compared to yesterday's close, we are flat after all of that. And this is just the first 10, 12 minutes of trade. Not even that for now. But we've got the next management with us, Sonia, now.
Yes, and the market is giving us some breathing time, right? And not all over the place. That roller coaster yesterday was a bit too much to handle. So flat for the markets as of now. But one space that has done really well in the past many weeks and months is this entire cable industry, cables, wires, etc. KEI Industries reported a good set of numbers, double-digit top-line growth, 16% actually, revenue growth, margins gained more than 300 basis points. Cables and wires, stainless steel wires showed very good growth, while the EPC project segment lagged a bit. We have Anil Gupta, the Chairman and Managing Director at KEI Industries. Mr. Gupta, it's always great speaking to you. Thank you for joining us yet again. This time the cables and wires segment was quite good. The revenue growth was largely led by that. But can you tell us what are the demand trends looking like right now? And do you think the 16-18% growth on the cables and wires segment, or on the top line rather, is something that you can maintain by the end of the year as well?
Yeah. Good morning, Sonia. I think demand is robust in public sector as well as in private sector. And we expect that this momentum will continue. We have also are getting significant demand from export market also. And you can see that our export has grown significantly as compared to last year. Almost 98% growth is there compared to same period last year. and this traction should continue. So I hope that next year also, as per our guidance, we should be able to maintain a growth of 15 to 16%. And by this year end, as guided earlier, around 16 to 17% overall growth is expected. We are able to improve our EBITDA margins also, as you have said, by 300 basis points. As per our calculation, it is 11%, but as per your calculation, it is 10.5%. So it's okay. And PAT has also improved.
So just one more word on exports. I think your long-term goal is to reach 20% of exports in your overall sales, right? You're currently 10%. By when do you think you can get to 20%? And what is the order book like in the export market? What's the order visibility?
This year, we expect to reach around 12% of our sales from exports. And for reaching 20% exports, it will take 2 or 3 years because we need capacity. We are building up capacity, and as soon as new capacities are on board, we should be able to bring that numbers in exports.
Okay, all right. Hi, Mr. Gupta. Good morning. Nigel on this side. Mr. Gupta, I had a couple of points with regard to the segments that you all have reported. One being in the housing wire and winding wire segment, out there you've grown by close to 23%, which is much better than a peer that had reported numbers last week. What caused this sort of a growth on this wire segment, if you could give us clarity?
Actually, I have not studied the other companies' numbers, but so far as we are concerned, we are trying to grow in every nook and corner, and we are trying to improve our dealership. And that is the reason that we have grown by around 23%. But overall, over the full year, it should not be more than 20% as per my expectation. Sometimes in a quarter, it is a aberration that you grow more.
Yeah. Okay, got it. So that's on the housing wire and winding wire segment. The other point I want to look at is EHV. I recall you told us, you should end the year, I think, around 500, 550 crores, if I remember correctly. You've already done more than 400 crores, and that segment is ramping up quite well. What do you end this year with on the EHV segment?
It should be reaching around anywhere between 550 to 600 crore. So the demand is good, and we hope to maintain this momentum next year as well. But our capacities are this much only. So next year also, we'll be able to maintain this much sales only.
Right. So hi, good morning, Prashant here. But it'll the EHV segment in FY25 should be. I mean, you said a 20% growth there as well in the segment, or should grow faster as compared to the others?
See,
you've done nearly 200 crores of sales this quarter, in a quarter.
I expect that next year also we should be able to reach around 600 crore, because I just mentioned that we can't produce more than that. So until we ramp up our capacity in our new upcoming plant, we will not be able to grow in this segment.
What can you provide us with an update on the capacity expansion that's going on?
The capacity next year, this year we expect to do a capex of around 500 crore, and next year it should be around 600 to 700 crore because our new plant is coming up at Sanand near Ahmedabad, and the first phase of it should be away 15 to 16 months from here, and the full project will be completed in 24 months from now.
Okay. I had one question on margins. You briefly mentioned it, but just wanted to spend a little time on that. Your margins are way below some of your peers like Polycab, Havels, Finolex, etc. Just trying to understand why that is. And when do you think you can get to this band of 11-12% margins?
No, I mean, we are almost at par with the Havels. But so far as Polycab is concerned, maybe because of the larger scale of operations and, operational efficiencies and logistics, they are doing little better.
Okay. So by when do you, just the follow up there, by when do you think you can get to, 11, 12%? Is it in this year? Are you looking at it in FY25?
I think we should be able to improve it by 0.5% next year, but to reach plus 2% level should take around 2 years.
So you're telling us, Mr. Gupta, that this year you'll end closer to around 11%. Next year you'll go to say to around 11.5%. And by FY26, maybe you could be in that vicinity of around 12.5 to 13%. At least that's the goal as of now. Things are volatile, but as of now, do you expect this is the trajectory?
Yes, of course.
Okay, all right.
Right, got that. We'll leave it there, Mr. Gupta. Appreciate you joining in, and thank you very much for coming on here on CNBC-TV18 with the results. Stocks up about 4% or so, 4.25%, looking very, very strong. The market's also stabilized now after a bit of down and up, 25 points, 21,260 on the Nifty. We'll take a quick break here. We'll have the management of Sona BLW Precision Forgings to discuss their third quarter numbers in a bit from now. Stay with us.
Well, one of the good set of numbers in the auto space came in from Sona BLW Precision Forgings. The company reported a solid set of numbers. Revenues went up 16%. Margins went up 360 basis points to 29.7%. The company's net order book has also increased. And, the company has now a higher presence in the electric vehicle space. Rohit Nanda, who's the Group Chief Financial Officer at Sona BLW Precision, is joining us. Rohit, thanks for being with us on the channel. Appreciate your time here. First, if you look at the 9 months performance, right, it's been very strong. Revenue growth of almost 20%. And now you're sitting on a base of around 2,300 crores. What is the full year revenue outlook, both FY24 and what can you reasonably do in FY25 as well?
Good morning, Sonia. So we actually normally don't give the revenue guidance. But going by, how we've performed, let's say, over the last 10, 15 years, we've grown at a 25% CAGR plus. And based on the order book and the current outlook, I think that is something which should be maintainable.
Okay, so you're going to grow at a 25% compounded growth over the next few years as well. That's what you're looking at. But, your order book, just to talk about that, has increased to 22,400 crores in Q3. How much of this will be executed in FY24 and 25?
It's actually 24,000 crores.
Okay.
I think most of the large orders, I will say, will start production by FY26. So it will happen every year. I do not right now have, let's say, a year-wise breakup, but by FY26, most of the large orders would be in production.
Got it. So good morning. Just a quick word on the contribution from EVs. I think it's now just under 30% of your overall revenues. Could you give us an update? Is it growing as you'd like? What's the rate of growth, and where do you see this in FY25?
Sure. So, EV continues to be our biggest growth driver. If you look at our order book also, 80% of the order book comes from electric vehicle segment. So we feel that this will continue to be our key growth driver in future also. In fact, we have an ESG target to do 45% of our revenue by calendar year 25. It should be 45% of our revenue.
And how much of this is this 80%? How much of this is India?
India, I think, should be about 15%. I mean, it's around 12 to 15%.
Is there a big difference between margins you make on EV work here in India and overseas, sir?
Look, the products that we supply in India are different than the products we supply overseas. So there is a difference in the margins, but the products are also different.
So what's the margin difference then, Mr. Nanda?
Well, we do not actually talk about product level margins, but overall margins is what we generally talk about. And that's where we feel that we'll be able to maintain the margins given the order book constituents.
But I believe you've gone ahead and you've upped your margin guidance as well. So you're feeling fairly confident on that front. Tell us what are the factors that are in play?
So Nigel, we generally, we have always said that our margins range between 25 to 27%, 28% actually. But for the last few quarters, we actually were doing the margin on the higher side. So we've kind of revised it slightly upwards. So partly because of the disinflationary factors, because when the material prices go down, although we have a material pass-through arrangement with the customers, but in terms of percentage, the margin gets a bump up. Apart from that, the product mix and operational efficiencies are also kicking in. So we feel that 28% should be maintainable in the foreseeable few quarters at least.
Okay, that's interesting. I think that's what the street also likes. The stock is up about 1% now. So you're saying, from an earlier band of 25 to 27%, now you're confident that 28% margins is what you can maintain. But there's also some aggression in terms of pricing, right, in the electric vehicle two-wheeler space, with a lot of the new players getting ready to launch now. Ather is launching a new bike as well in April in the family segment. So there's so much coming through in the next couple of months. Do you feel that pressure in terms of pricing, and could that derail your margin targets a bit?
No, so yes, I know what you're talking about. So there has been a sort of a pricing aggression, so to say, in the Indian two-wheeler market. But one, we feel it's temporary, cannot be maintained. And secondly, we are well diversified across the industry. So we actually have about 14 odd customers with whom we have orders, and of them, I think we are right now producing and supplying to 4 of them. So our order book is fairly diversified. So we don't feel that it should, be a long-term phenomenon that prices are aggressively cut. And secondly, we feel being well diversified across multiple customers, that should also help.
Rohit, this EV margin business, it goes to the heart of the question for EV makers as well. Would margins be comparable to ICE petrol products and ICE engine products? Because there is technology, there is innovation, you've got to do all of that, right? At least here in the Indian context, it's mostly assembly when you look at EVs. So can margins be comparable, or will there be a big difference?
Look, if you're talking about our margins have actually not gone down, though, as I said, our key growth driver has been sales to the EV segment. But if you're talking about the end vehicles, then that's a different sort of context.
But even for you, you're saying that there is a difference, but you don't want to disclose that between products which you export and products which you supply here on the EV side.
Yes. So there is a bit of difference. Also, it comes from the way market is positioned. So in case of, let's say, what we export mostly, the driveline products. So there is massive technological, let's say, differentiation, value addition that we do for the customer. So even for the domestic segment, there is value addition, but in terms of product categorization, the differentiation is not as much from the technological standpoint. So that's where, we are trying to innovate also. And you might have seen that we have recently won a contract wherein we'll be supplying an integrated motor controller for the first time in India to a traditional two-wheeler manufacturer in India for their electric bike. So we are trying to do that to do value addition for the customers, thereby trying to create some differentiation for ourselves and for the customers.
That's interesting. In Q3 itself, you won 5 new EV programs, including onboarding 2 new EV customers in 1 quarter. That's quite a bit. I mean, is it lumpy, the kind of order wins that you're getting, or is it sustainable? Just trying to understand what was the total quantum of orders of these 5 new projects, and what could the run rate be in EVs over the next few months?
So look, order intake can be lumpy because before we win the order, the work that goes behind that can range anywhere between 6 months to 1.5 years, because we need to work with engineering teams of the customer. So these are mostly customized products. So generally, it's not like a steady state that every quarter we will have a run rate order win. But yes, there can be quarters wherein we may have lumpy order wins. And in this quarter, we had 5 orders. But we've actually been, if you look at our order book, we've been adding to our order book ever since we've got listed. We've been publishing these numbers. So if you look, let's say, beyond quarter to quarter basis, you would see that our order book has grown. I think when we got listed about 2.5 years ago, our order book was about 13,000 crores. Now it's 24,000.
24,000 crores. Yes, absolutely. That's been a good growth. Even your market share, right, in key segments, whether it's differential gears, whether it's starter motors, your market share has gone up quite a bit. So can you tell me, overall, is there scope to improve market share further? And if yes, any kind of internal targets that you'd have?
So there are no targets, but yes, growing market share is one of our key strategies, because if you look at the underlying market, the automotive market, if you were to take a base of 2019, which was the peak year for the global automotive market, so it's still lower than that. So it's not grown in the last, let's say, 4 or 5 years. So intermediate, I mean, you will have 1 year of growth and probably 1 year of decline. So the only way you can grow is to get into new products. You can increase your market share, etc. And this I'm talking more on a macro basis, on a global level. So that's a key strategy that we have, that we need to grow our market share. And our sense is that though there is no research or anything that goes behind it, but based on how the market is structured, I think 15% market share may be generally what we consider as a cap, beyond which it becomes difficult to grow.
Okay. All right, Mr. Nanda, good to hear your thoughts. The market, I think, likes what you're saying. You're sounding optimistic on business prospects. Wishing you all the best, and we look forward to chatting with you all through 2024 as well. We'll move into the next management then. That's CG Power. Well, it reported a steady set of numbers. So that's Q3 numbers. Revenues improved by around 13%. Margins saw some bit of contraction. To discuss this and more, we're joined by Mr. Natarajan Srinivasan, the Managing Director and Chief Executive Officer at the company. Hi, Mr. Srinivasan. Good to speak to you for the first time in 2024, and always look forward to this quarterly chat with you. Well, for the last few quarters, I've been trying to get you to talk about that revenue growth guidance for the year. And I've been hinting at that, pure going by mathematics, 7,500 to 8,000 crores. But you keep telling me, no, Nigel, we are sticking to 7,000 to 7,500. Now, Q4 is the best, and you're already at 5,900 crores. So will you end this year closer to around that 8,000 crore mark, point number 1? And going by what is in the pipeline, what kind of a growth number are we looking at for FY25, Mr. Srinivasan?
So I think Q4, probably we can do about 2,000 crore sales. So which means, it will add up to close to 7,750 to 2,000. Based on order book, I think we can grow next year by about 20%. We can grow the top line by 20%.
Okay. And on the margin parameter, Mr. Srinivasan, you will be maintaining it in this vicinity of mid-teens, around 15% is doable?
Yes, doable.
Okay. Let's talk about, the segmental breakup then. Because in a couple of your segments, you had some bit of pressure on margin because of pricing. Do you think now you can take some price increases? And what's your strategy going ahead? Because you garnered some market share, but pricing was under pressure. So your view out there.
No, pricing is under pressure, came under pressure only in LT motors.
Yes, LT motors.
So LT motors, I have to give you some details. For last 2 years, 21, 22 and 22, 23, the industry, LT motors grew by about 20% plus. For the current year, till October, the growth is industry growth is about 10.8%, whereas during the same period we have grown by about 28%. All these in volume terms. So in Q3, what happened? There has been a big sell-off by competition. We took a strategic call to aggressively sell and then retain the customers and then protect our turf. See, in that process, our market share, which was at 34% as of March 2023 in LT Motors, has gone up to about 38% as of October. So that explains the reason for the pressure in LT Motors. Here again, there are two segments in LT Motors. There is a direct order flow from the OEMs to whom we supply. That order book continues to remain strong. Then with respect to the dealers actually, where the stocking is coming down because there is an expectation, because the commodity prices have been seeing a decline, both copper, steel, etc. But nobody wants to stock more because if the price goes down, there will be an inventory hit. I briefly explained this in the last quarter. I feel the worst is over. From Q4, margins can definitely improve.
All right, Mr. Srinivasan, good morning. Prashant here. Sorry, just a amateur question. LT Motors is what?
Low tension motors. Low tension motors.
Okay, and used mainly for, sir, end use?
So industrial purpose. High tension motors is actually what is called as large industrial motors, which goes into project applications like water, wastewater, and both industrial application. That growth remains strong.
Okay, all right. So the low tension motors is where there has been some pressure on pricing, especially. Mr. Srinivasan, just talk to us a little bit about the power segment, sir, which has seen some uptake. And generally, there is a fair bit of optimism that every day we hear, we read a new report or two talking about how this sector has entered a new capex phase. Demand is strong, but new supply is hard to come by. So that entire value chain on the power side will see fresh investments. Are you seeing that in your business? Talk to us about that.
No, absolutely. Both the transformer, switchgear, and allied products continue to grow strong. The order book has continued to be very healthy. And also, as I said, inquiries continue to be about, in transformers still we have about close to 10,000 crores of inquiries, of which at least about 2,000 crores will be decided in the next quarter. In switchgear, the inquiries are around 2,000 crores. This quarter, actually, in the power segment between switchgear and transformer, we exported about 100 crores. For the year, for the 9 months period, we exported more than close to about 400 crores we exported. Export demand is also strong. As I said earlier, there's definitely a supply constraint. We are trying to get our capacities, the increased capacity expansion up and running as early as possible.
Okay. Mr. Srinivasan, hi, good morning. You said that in FY24 the margins will be in mid-teens, but I also understand that you've initiated a project Mudra to improve, for cost-cutting initiatives, whether it is cost reduction, vendor consolidation, capacity building as well. I want to understand how much could the benefits of this be, both in FY24, FY25? What are we looking at in terms of cost reduction and impact on margins?
So I think it will be difficult to quantify exactly, how much margins will get in terms of percentage. If you take power, for example, in all these, we get market-related prices. I don't get an extra price. Whatever margin improvement we have been able to bring in mainly because of Project Mudra, which is like a procurement efficiency. And as I said earlier, we are now cash surplus, therefore we are able to pay cash and then get the best terms for procurement. We are also working on the lean manufacturing with a Japanese firm for the last 3 years. That has also started kicking in. I would say at least about 1.5% to 2% cumulatively, the benefit on account of these will get reflected in the bottom line.
Okay. I just wanted to also come back to in the industrial system space, right? There are a few higher end customers that have started moving towards this IE4 motors as well, both in India as well as in Europe. Just trying to understand that once your new capacities come on board over the next 1 to 2 years, how much of a focus area will exports be for you? And you spoke about the overall top line growth of 20% in FY25. How much do you think over the next 2 years could be contributed by exports once the capacity comes on board?
So target is to move at least to 20% of the motor sales into exports. I think this will happen either in 2 years or 3 years. We have already started working on it very seriously and aggressively. So next year, at least, we must do about 7.5 to 10% of sales in motors for export markets.
Sorry, you said 20% of your motor sales will come from exports by when? By FY25, is it?
By about minimum 2 years or maximum 3 years, 2 to 3 years, depends on how we progress well in the effort.
Okay, all right. Mr. Srinivasan, tell us about this application you've made for setting up an OSAT facility. I believe that you're in discussions with various listed foreign players as well. So could you give us some guidelines by when could we hear firmer plans on this front? And since you're already in talks, I believe, by when could we hear more about this?
So first is, the application has to be cleared by the government, both for the project as well as for the subsidies. This project is eligible for 50% central government subsidy and 25% state government subsidy, capital subsidy, which means about 75% of the project cost will be funded through the capital subsidies. So the discussions with the foreign players or technology providers are on. Since they are also listed, they need to get their approval, and currently there's amount of confidentiality. Once these are cleared, maybe in about by end of February, I think we should be in a position to tell something clearly.
Just a quick word on the railways segment as well. What is the kind of opportunity that you have right now? You did mention earlier that you're working on several partnerships to fill the gaps in your portfolio with respect to the railway segment. But just trying to understand over the next 1 to 2 years, what could the size of the opportunity be for you?
So currently, some of the project orders have taken a breather actually. Maybe the project orders will come only after the elections are over. But on our current products, actually, we have got very good orders this year. The unexecuted order book is about 1,050 crores as of December. We hope to end the year with the best ever order book position as far as railways is concerned, because we have been quoting aggressively in the tenders and getting a lot of orders. So going forward, still, as long as we are not able to get a tie-up, our ability to get project orders are restricted. But there is a lot of work that is going on.
All right, we leave it at that, Mr. Srinivasan. Thanks a lot for stopping by. Always nice listening to you and understanding more about your, multifaceted business. Thanks a lot for joining us. Right, that's CG Power. Let's do one thing. Let us take a quick commercial break. On that note, on the other side, Mitesh Thakkar will join in for some technical trades. Stay tuned. Well, it's not a bad move in the market at all. The Nifty is up 100 points. The Sensex is up 300 points. After yesterday's downtick, we've sort of redeemed ourselves a little bit. Let's see how it goes. The day is long. Mitesh Thakkar is with us to give us some cues. Mitesh, how are you feeling about the day so far? And what is the, what's the outlook for the rest of the day?
I think a stronger bounce back is taking place, but as I said, I would want to see us capture and close about 21,340, 350 right there. So we'll keep a watch. My initial feeling is that I think we might not be able to do that. So we're not taking aggressive longs over here. I think some positions have been taken. On the stock side, Zydus Life is something which I recommend to buy with a stop at about 715 for targets of 760. And on the sell side is Tata Steel, which I would recommend selling with a stop at about 134 for targets of 125.
Okay, all right, Mitesh, thanks a lot for that. Well, let's address one of the top losers on the Nifty itself, that's Axis Bank. Abhishek joins us to give us a quick revision of those numbers. Abhishek, the stock was down 5%. It's recovered a little bit from the day's low.
Well, that's with the market as well. So let's begin with Axis Bank. Deposit growth is the big highlight given the fact that the sequential deposit growth on a quarter-on-quarter basis above 5% is perhaps the highest that you are seeing amongst peers and, one of the strongest one in an operationally weak quarter that Axis Bank has seen. So deposit growth is 5.15%, best amongst peers. YOY deposit growth of 18.5% is the best in last 8 quarters. The watch list at 0.54% is the lowest in last 8-9 quarters. X of Q2 FY24 slippage ratio is the lowest in last 12 quarters, and in terms of asset quality, one of the best in last 8-9 years, both with gross NPA ratio and net NPA ratio. On the negative side, operating profits have declined YOY for the first time in last 6 quarters. Core operating profit growth is almost flat on a YOY basis, and sequentially also it's one of the weakest when compared to peers as well at just 1.35%. A 5-quarter low in terms of net interest margin as the book was built up with wholesale deposit in the deposit side, so that actually impacted your margins. Its domestic net interest margin is at 6-quarter low. CASA ratio across industry, you are witnessing CASA ratio decline, and no taking away from Axis Bank as well, 14-quarter low in terms of CASA ratio. In terms of their PNL, it has met our poll. Back to you.
All right, thanks a lot for that. Well, Pidilite reported a good set of numbers. Mangalam is here to tell us more about that. Mangalam, over to you.
Well, it was a strong operational beat that came in from Pidilite. In fact, the overall volume growth of the company also was 10.4%, led by the consumer business, which had a volume growth of 10.3%. The street was working with a number between 8 to 10% itself. The revenues were up 4% year on year. That's largely because the company, passed on the price benefits of lower raw material costs to the customers, but that didn't deter them from seeing a 1100 basis points jump in the gross margins. EBITDA was up 50%. EBITDA margins close to 23.7%, near the higher end of the company's guided 20 to 24% range, and the net profit as a result of which up 66%. This morning we have an upgrade coming in from JP Morgan as well. They've upgraded the stock to overweight and the target price has been raised to 2,900 rupees. They say that there are multiple factors at play to support healthy revenue growth momentum in FY25, and they've raised their FY25, FY26 EPS by about 3% as well. They believe the earnings downgrade is behind Pidilite, and as a result of which they expect a mid-teen sort of CAGR over the next 3 years.
All right, thanks a lot for that. Well, Reema's with us to talk about Indus Tower and how the numbers look. Reema, over to you.
Thanks so much for that. So Indus Towers is holding up in the green in a weak market, and there are 2 key positives. One, the receivables from Vodafone Idea have come down on a quarter-on-quarter basis. It currently stands at 64.1. These are the provisions for doubtful debts. 64.1 crore this quarter, which compares with 133 crore in the prior quarter. And the total receivables from Vodafone Idea, the total doubtful debt, stands at about 5,700 crore rupees. Secondly, the tower addition has been very strong at 7,500 towers in Q3. And the company says the expansion of the net adds in towers is due to Bharti's ongoing rural coverage expansion. There is a conference call scheduled at 2:30 p.m. where UBS says they expect the management to provide more color on the status of payments and receivables from Vodafone Idea, as well as the overall demand outlook for FY25, as they believe Bharti's rural expansion and 5G rollout will start slowing down from FY25. Back to you.
All right, thanks a lot for that. Let's slip into a quick break on that note. On the other side, Lata will get chatting with Sameer Arora, founder and fund manager at Helios Capital, about the sudden sell-off that we've seen in the Indian markets, particularly in names like HDFC Bank. More on that coming up.
The Indian market is suddenly facing a bout of concerted FII selling and all kinds of selling. The Nifty, which was a tall 18% gainer in 2023, has lost over 2% in January and much of it this week. The small cap and the mid cap indexes, which had gained over 50% in 2023, have done worse than the Nifty this week. And much of this is due to FII selling. What's the trigger for this selling? I have with me one of the best in the business to answer all our questions in this one, Samir Arora, founder and fund manager of Helios Capital. Samir, thank you very much for joining us. And my apologies, I know I invited you for a pre-budget special, but since I invited you, there have been a series of events which have changed priorities for the market. And therefore, let me start with this.
But may I say
selling.
that if I properly understood that you're calling me for pre-budget, I wouldn't have come because there's no budget.
Okay.
It's
there is a vote on account. Yes, there is.
Nobody's interested in that.
No, the bond markets are, incidentally. I mean, the borrowing and all that. Anyway, what's your diagnosis of this bout of selling that we have seen?
So this selling, first of all, let's not call it real selling. First of all, we are also FI, we have not sold. But big picture, some of that selling could be attributed specifically to selling of HDFC Bank for a few days. And broadly speaking, I don't think this is any selling which denotes anything about FII's view of India. By the way, tonight I am flying to US. And there is so much interest in India, and let's see now how it converts to flows for us in the market. But in general, I don't think this Jan selling, whatever you want to call it, is some big number for which anybody should panic on that account, at least.
Okay. But for your take on HDFC, as you said, the people have sold HDFC Bank. You have a sizable holding in that stock.
So we have not sold any. We have not sold all our funds, have it, including our mutual fund. And, our business model or investing model is such that even this month, even our mutual fund, whose NAV you can see, has outperformed the market after having our number one stock being down 15-20%. But let's look at it beyond that. Let's look big picture. Sure. How do investors expect as returns from the stock market in general, other than some people who invested 1 year ago and think that is normal? You expect 15-18% return per annum from the market. Now, I see that for some small news here or there on any stock, let's say IT stock A versus IT stock B. If IT stock A has done little better, people will sell IT stock B and buy IT stock A, and in 1 or 2 days make the difference between two stocks. That means one up 7-8%, one down 4-5%. And they make it almost like a year's return in just switching from stock A to stock B. Let us say for HDFC Bank, big picture, if you believe everything has been delayed by a year because the merger benefits and the reduction of the HDFC liabilities to the original HDFC liabilities to deposits and low-cost deposits, everything has been delayed by 9 months, 6 months, 12 months. How much is that worth? It is not worth less than this, what the market has already fallen. And on one piece of information where everybody broadly knew that you are starting with a different slate, you are doing a different mix than other banks, to then compare that this NIM has gone up and that NIM has gone down, I think is beyond normal requirement of this job. I think big picture, you will do sufficiently well in these big banks. We always classify our holdings in two categories. One where we want reasonable return but with high confidence. And the other one is where you are buying new things, turnarounds, companies making losses, somebody having resigned, something where you feel that the market is overreacting. Not every stock has to give you 30%. Some of them have to, but some of them are there for steadier return. I still think HDFC Bank is in that category.
Okay. There are a lot of people who are still holding that stock like you are. So what's your take? Would you expect a turnaround in a year? What disappointed you and what are you looking forward to in terms of
I think more than disappointment is you need a little bit more enthusiasm on these calls. These market people are sheeps. They have to be guided. So I think it was bad that, I can say it openly, Mr. Jagdishan should have been on the call. And number two, you need a little bit of aggression. You don't need to apologize. You have to guide the market. If you see these other calls of the other banks, What do you think they have done very materially different from this bank? Nothing. It is just that you have to be on the front foot and not be pressurized by the market and guide them. There were a few disappointments in the sense that, there was no need to have this expectation that we can raise this much retail deposits every quarter, because they did do a good job in the previous quarter.
Yes.
So maybe it should have been an aspirational thing that we are hoping to get whatever that 1 lakh crore or whatever in a quarter or something. That broadly don't make it as a hard, fast guidance. But beyond a point, forget about them. The market also knows that they, all around them, they can see that our Indian economy will grow in rupee terms at 10-11%, that the financial sector will grow 2-3% more than that. That is just the way financial sector grows relative to the GDP, and therefore you are not losing your market share in anything. You may gain or not gain. You are going to grow 15%, 14%, 16%, which is a good enough number. And in between, you'll have some spurts where you will be able to reduce your cost or increase your NIMs again, because the HDFC Bank merger has brought in these low margin businesses, but that is understood. Now look at the other NBFCs, the big one, even look at Bajaj Finance. Where is it growing? It is growing in the low NIM housing finance business.
Yes.
Here this fellow has merged, that fellow is buying, everybody's doing the same thing beyond a point. It is the fact that large companies don't normally grow at 14-15%. You please look at whatever is the best guidance for next year for IT. 10. 9, 8, 11, but it looks like a turnaround. And those stocks are trading 50, 60, 70% higher than 2019 multiples. So, but all in all, our model is different. Our model is you don't put all your eggs in one basket. We have 35 stocks, something goes up, makes up for something else. It's a relay race. It is not an all or none. Every morning I can come and make fun of HDFC Bank, even though it's my top holding. One thing I learned from the market is that people say that stocks go up when you start making memes and make fun about these stocks. So I don't mind making fun of HDFC Bank if that is what it takes to go up. But the point is this over hyperness of taking 10 to 15% delta in moving from bank A to bank B, moving from tech A to tech B. I don't see how that serves any purpose. That is big picture what I feel.
Yeah, but there is also a little bit of worry over the financial sector itself, not just HDFC, because the margins would have peaked. We have seen that sector underperform after really being the flag bearer for the earlier part of 2023. So who was the next flag bearer?
Not really 23, because if you look at the big banks, HDFC Bank, I think, was up 6%, and ICICI was up 10-12%, and State Bank was up...
No, Nifty was up 18. Nifty was up 18 in that sense.
That's what I'm saying. In that sense, these stocks they had hugely underperformed in 23.
Yes.
Although 22 and before, ICICI and State Bank did well for 2 years, and generally over life, of course, HDFC Bank you can't compete with. But broadly, what I'm saying is they have underperformed. Now there are other groups that are also underperforming or doing badly in terms of guidance, which is IT and consumer. So do you think levers will grow 12% or the other side, these IT guys will grow 12%? No, these guys will definitely grow 13, 14, 15%, at least as of now we think, or maybe 15, 16. So it's not bad. Now you may say, how can you compare an IT company growth with a financial growth? All that is second level.
No. So in that case, Samir, see, you've spoken about consumer staples, you've spoken about banks, where also the NIMs have, peaked off, and you've spoken about IT. If everywhere it's going to be high single digit, then do you think that the Nifty's gains is not 18% now? It's much less.
No, it won't be. Never. It's never going to be 18 so easily. No, we never say that. The average longer term Nifty or market growth, because sometimes we take NSE 500, sometimes Nifty, will be 13, 14%. And anybody growing 15, 16, 17% is valuable. And then you are trying to buy some of these newer things or different things where you might grow 25%. But the whole market or the big guys cannot grow 18% their earnings this year. No chance. That is 25.
Okay. See, you also have L&T and Adani ports. And there is a feeling in the market that the government will, in the next budget as well, and see, I'm keeping my budget promise, will also be a capex heavy budget. So you think that therefore it's good to persist with infra stories?
Well, these are the only two infra stories we are willing to have, where there is our confidence that they will get their money from the government. If government or some state government or somebody doesn't have money, I don't have the same confidence in the contractors and these railway guys and all these guys who go into every order with low margins and get their working cycle extended. So big picture, we like these two. But that does not, we don't call it an infra story. These are specific stories and only two that we have.
So you're not buying any of the railways, the power companies. These were the ones that showed a lot of...
Power companies are different. Power companies are different. I meant, we are talking about, because we own NTPC also. But I meant in general, these contractor type, not port, of course. Adani port
got it.
And
Yeah.
it was
but power, you are bullish.
Power, we are bullish. In big picture, obviously, there will be power shortage and all, but these valuations look so, obscene, as if these are the, we have seen this in the past and we resisted and we bought some and left some, which is the chemicals. Because we are not used to having these kind of companies trade at obscene valuations as if they are the new consumer companies or the new IT companies. But in general, we are more diversified than we have been because broadly we don't have IT. And so IT used to take around 20% of the portfolio, and that 20% has gone into different things which previously IT would have taken. And because those stocks have also done as well or better than IT, we are persisting with our negative thing relatively, if not absolute, but I think also absolute on IT. And therefore, we have more than usual mix.
Okay. No, since you said you're going to be going to the US to speak about the India story, and that's something many investors want to hear. This year, do you this year, do you think that we can have very good returns? It looks like the US economy, for all the rate hikes, is still in good shape. And in India, this financialization, conversion of bank deposits to, stock market holdings seems to be here for the long run.
Depending on what you call very good returns, I call that market should do adequately well and I should beat the market. That is what I call a good year. I don't call a good year that the market is up 25, I am up 20, but I had a good 20% return. I am okay with 16 if the market is 13 because I am a relative plus absolute combo in my mind and in how I think of my year being good. So I think that the market in general cannot have 20% type of return this year. I don't think it can have. It'll have mid-teen kind of return because what happens is after the event, like it happened, when the Bitcoin ETF was approved, after 2 days you found the ETF, the Bitcoin down 7.5% in one day. After this great this thing of Ram Mandir and all yesterday, so the market fall. I have a feeling that after election, everybody will celebrate that BJP is back for technical reasons, for hype reasons, for overexcitement reasons, it will fall first. 5-7%, and every time it falls 5-7%, it takes away basically 2 months of returns. If you're thinking that the returns are 20% in a year, I think if we make mid-teen returns as a market, it will be a very good year. And we think that has a high probability of getting somewhere plus minus that.
I have two very quick questions for you. One, there was a chatter in the market that SEBI has asked funds with more than 50% exposure in one stock to reveal their beneficial owners, and that's led to selling. You buy that? I mean, the version of...
It may not have led to selling, but it's a big overhang. I don't know in one day whether it could have led to selling because this thing has been going on for 2-3 months.
For 6 months,
So the people or the FIs who have more than 3 billion would have known or would know by now what they have to do. And maybe they are asking for time or they are asking for exemption or they are asking for waiver. But what I'm saying is it could not have suddenly crystallized yesterday.
Yeah.
So, but in general, it's an overhang, and I hope there is a solution to this because there will be many funds which we have, not all investors, but some investors saying every underlying fund in ultimate beneficial owner is a complicated thing. They'll have to take approval from the client first. And
they have excused a lot of funds. They've excused a lot of funds. SEBI has excused a lot of funds. For instance, if you have high ownership in a stock which has no identifiable promoter, like an HDFC Bank, then you don't have to reveal. So there are a lot of exceptions.
I didn't know this one. Okay, whatever. Okay. So possible.
So they are only interested that the MPS rule, minimum public shareholding rule, is not a sidestep.
That part I agree. No, that part is easy, that if you have more than 50%. But I thought there's a second rule which says if you have more than $3 billion, anyway you have to disclose.
Yeah. That
is more complicated.
That is India's borders. That is funds across India's borders, the Bangladesh, Nepal. That's a different rule.
If you have more than 3 billion, who will have? Maybe a few funds will also have, but mostly it will be the P-note guys.
Yeah.
Because they are aggregating for thousands of underlying investors. Now, there are rules for those guys, but to say each of them who has bought a P-note should disclose his ultimate beneficial owners because he bought 5 million of a P-note, that I think many people may choose to say yes or no. We anyway don't have 3 billion, but India-centric guys can't escape, so they have to do whatever is asked. But others may say, it's too small, but these small things aggregate over time or over different players, and it becomes, sort of an overhang.
Okay, I'll check out on this P-note thing. I'm not very sure SEBI is after many of those guys. But just to come back to the most important reason why I called you, give me a budget bite. What are you expecting from the budget?
So budget day, I'm not even here. I'm in US, so I won't even be watching. Enjoy it and let me know if anything happens.
You're not expecting some announcements on capex or deficit?
No. I thought you're not supposed to have all these big announcements just before an election. So I don't think much.
You can announce.
There's nothing wrong with that. Whatever is happening is good. You don't need more and more of these announcements.
Fair enough. Thanks a lot, Samir Arora. It's always a pleasure speaking with you. Thank you very much for joining us on Bazaar. Well, that's it of this very delightful conversation. After a break, Chartbusters.